Our first panelist for this session is a Managing Director of Investments at Morgan Creek. Please join me in welcoming Mr. NIRAV KACHALIA, Managing Director, Morgan Creek Capital Management. Prior to founding CX Partners, our next panelist headed Citigroup's private equity business in India. Please welcome Mr. Ajay Relan, founder and managing partner, CX Partners. Our next panelist has been involved in private equity and venture capital since the late 90s. Please welcome Mr. TAPAN MESHRAM, Senior Investment Officer, State General Reserve Fund, Ministry of Finance, Oman. Our final panelist is a co-founder and managing partner of Everstone Capital. I give you Mr. Samir Sen, co-founder and managing partner, Everstone Capital. And now we hand the floor over to our moderator, Mr. GARG, who will take us through the next 1 hour.
Thank you very much. The first question, I guess, let's kickstart to see where do investors place India in general and Indian private equity fund managers on the risk-reward scale compared to the rest of the world, and how they are viewing the Indian market and the private equity landscape in India, which is probably pertinent for our discussion. So I'll let Nirav kickstart.
Just to give you some context, my team and my portfolio consists of about $4.25 billion invested across private assets globally. So as a firm, we think about risk return on a relative basis on a daily basis. And so really what drives our decisions is what's the most attractive risk return in combination with portfolio construction. I think today, it's a very interesting time, and so when you think about risk return, you have to look at both sides of that equation, and so if you begin with return, since most people really like to focus on and think about returns, India has really not held up from a private equity perspective to date. I think most investors have had some level of success. Even by achieving the average in Western developed markets. I would say outside of venture capital, they have had success and they've made money. And so from a return perspective, people get comfortable with the strategies, with the fact that, again, they may not achieve incredible outperformance, but if they achieve some premium to liquid returns, then they're happy. And I think that in the West today, from a returns perspective, that is generally the mindset. They talk about it, but less people focus on, I think is very important. And I think would change people's mindsets and allocations if they really understood that better. I would say on a high level, we think that the risk in emerging markets relative to the West, that spread has come in. And so I think people have again, because they've had such success in the West in these environments, they've said, okay, we understand what risk is in the West, but I think that really fundamentally has changed. So I think from some perspective, investing in emerging markets should provide a better risk. If you drill down to India on a relative basis, unfortunately, I think India has has come in and then it's gone out again a little bit from a spread risk. And I think the people began to believe that this fundamental underlying growth was strong enough that can obviously provide some downside protection. However, the role of government today, or the indecisiveness of where the government is going, the structure of the private equity marketplace today and how deals are structured, and valuations has kind of helped, I think, bring back up a bit the risk from an India perspective. So when you look at it from both risk and return, India doesn't necessarily stand out in a global mindset on a day-to-day basis today. We're hoping, and I think that if you want to think on a go-forward basis versus a historic basis, that India has a number of positive things coming that should hopefully tilt that back in the favor of India as a standout market relative to the rest of the world. But I think from everyone's perspective, there's a fair amount of cynicism about locking your money up for a long period of time and that producing a suitable risk return.
Thank you, Nirav. So not in a very hot spot. I'll let Tapan go and give his perspective as to how they look at India as a market.
Thanks, Praneet. I've been involved with sovereign entities for some years now. So I thought Pranit asked me to share something about that. Let's say when we talk about the first funds or the funds that are being managed by managers who have done investments with other funds, that may be still acceptable. But when it comes to funds which are being raised by managers who don't have significant investments experience, there's a different story altogether. As sovereign entities, we have certain responsibilities because of which we have to be more careful about who we are investing with. Now, I can tell you very clearly when first-time funds come to us, to sovereign entities, it becomes very difficult to qualify through the first checklist. Primarily because, if there is something going wrong with the first-time fund, it becomes personal responsibilities of the managers who recommended such funds. So because of these fiduciary duties, it's very difficult for us to relate to first-time funds. From a geography point of view, at least in the Middle East, there was a clear preference in the past for Western economies, the US and the Europe. But pointing out to what Nirav highlighted, which is with respect to the distressed situation now in the Western economies, it's tilting now towards Asian economies as well. And India, of course, is a very, very important player there. And what is also happening, within the sovereign entities, there are typically two teams. One team which invests into funds, and there are now teams which are looking at direct investments as well. And over a period of time, given that the direct investments team are unable to find good opportunities in emerging economies like India, there's a feedback mechanism which is going back to the funds team, where the funds team are encouraged to broaden their view and look at, even if it's the first-time fund, look at the underlying fundamentals of these first-time funds and look for co-investment opportunities in these first-time funds. And in terms of co-investment opportunities, these have to be fairly large ticket sizes, at least north of $40 million for sovereign entities to be interested, because otherwise these co-investments cannot be done as per our criteria at all. So these are the few things which I felt. Thanks.
Thank you, Tapan. I think we'll talk a little bit more about first-time funds and a couple of things around that. But let's shift gear and talk to a couple of people who have built private equity organizations here in India, ground up, and ask them, what does it take, to build a private equity business in India? Let me start with Ajay, who's obviously been around in the private equity business, but what did it take to really build a private equity business, not only just an investing shop?
Well, I think it takes, to begin with, three things. One, I think you need to project yourself as an entity which people can trust. I think trust is a huge factor. These are LPs which are giving you a blind pool of money. So I think one of the reasons, firms like ICICI, Tata Capital, etc., succeed is because they seem to be, or they're seen as, solid institutions which people can, lay their faith in and know their money would be safe. Now that's a hard one. How do you, project that image that, yes, this is a trustworthy team, but I'll come back to that a bit later. I think the second thing is that there is no substitute for experience, and I think the team needs to be, that you've put together, needs to be a team with a deep experience and wide experience. And the third is, of course, that the strategy you outline should have two components. One, it can't deviate too much from what you've done before, because then people will say, well, now you're implementing an entirely new strategy and you may fail at that. They want to see success being repeated. But at the same time, that strategy should also stand out in terms of what others are doing. So if it is very much a Me Too kind of a game, then I think people would, would kind of pass up the opportunity to invest with you. So I think trust, experience, and a strategy that's consistent with what you've done in the past, and yet it's something which, truly stands out. I think you put this in the mix, and then I think throw in a lot of luck. I think you might be able to raise a fund.
All right. I'll let Sameer talk about this since he's built a big organization here on the ground.
So look, I think it's mostly what Ajay said, but I'll add a couple of things to that, and probably, taking his lead on the trust issue. I think transparency and clarity is very important. And I think what I've found over the years is, at the end of the day, all of us make compromises, and we try to gauge what an investor wants to hear, and over time start to say those things. And no disrespect to anybody, but investors change their mind on a regular basis, and what they want to hear and what they like is different. They might like venture capital in a particular cycle, they might like growth equity in a different cycle, they might like buyouts, they might be pro-India, they might not like India, and it's impossible to get it right, where if you take all investors' views and put it together, you'll get zero. So, you basically can't be everything to everybody. So what I would suggest is you have to be clear about who you are and what you do. You have to believe in what you think is the right business model for you. And I think you have to be very transparent about it from day one. And I think it's just that clarity and transparency, not everybody may like it, but those who do will learn to trust you. And I think obviously you have to execute what you say. I think the biggest way to break trust between an investor is to say something and then post the fund, do something else. And I'm sure the LPs look at that as a big red flag when that happens. So clarity, transparency, consistency, I'll throw that into that bucket. The second thing that I would say is that, this is a business where you have to be long-term greedy. Greed is important, but I think long-term is even more important. I think that it's a marathon, and there's this, famous US movie called Field of Dreams where they say, if you build it, they will come. And I generally believe that rather than how it used to be done, which is a little bit of a artiste boutique, where you raise some money, and then if you raise more, you add more resources, and then you raise some more capital, and you get some performance fee, and you open other offices. I actually think what you're asking the investors for is a big leap of faith. You're asking them to pay you, fees that are probably higher than in most industries. Performance fees, you're asking them to give your trust for 10 years, where they have virtually no say in what you can buy or sell. But I think to do that, you have to demonstrate that you're going to build an institution. I think it makes more sense to do it before, and the investors will have a lot more faith and see that what you're actually doing is the right thing for their capital.
Would you like to talk about if on the investing side, your strategy has evolved and how investors have taken to it for good or bad?
Praneet, may I just mention a few things on what Sameer said? Institutional memories are very short-lived. And as investors, when we hear several GPs coming to us, the opinion that we form of what we want to do, what our strategy should be, actually is driven by what we hear from GPs, from funds. So for example, if you have 10 funds coming and telling you that this is the sector that you should be focusing or they're focusing on. So actually the feedback loop becomes very important for investors to form an opinion. So they don't change their mind so rapidly, but them changing mind comes from what they're hearing from the funds. Two, if a fund manager ends up changing his strategy in between, it may not bother the investors as much, because at the end of the day, they just want to see the financial returns are met. So they would not have any objections as long as you deliver the returns. But, and strategies have to involve, for example, you're raising a fund today for next 5 years. Things change. So strategies can change. And it's not necessary that these strategies have to be cast in stone. Those are the only 2 points that I wanted to mention with respect to that.
NIRAV, can you respond to that?
Yeah, I would. First of all, the takeaway that I hear from both these is that LPs really don't think for themselves, and they don't really know what they want until we're taught. I would say two things, and I'd say that what we say and what we do, I think in many cases are very different. And I'd say that we are as inconsistent as GPs are in many cases. We'll talk about we want to see results, we want to see real returns, we want to see this incredible growth that's happening in India. We want to see these businesses make profits, and then we're happy going to fund every VC fund that we can find. None of whom have done anything more necessarily than any of the growth equity funds per se. So I would say that the reality is it's an evolving market. Absolutely. In some cases, we really don't have an idea because it changes so frequently. What I would argue, though, is that I think somewhat similar to what Samir was saying is that you really need to know what you're good at. What is your pitch? What is your angle? What is your edge? On my team globally, the first question I ask on our weekly Monday meeting globally is, in 1 minute, give me the edge of why this fund is worth a second meeting. And if we can't do that in 1 minute and explain, then there's another fund out there, okay, with another opportunity. And so consistency of what you are and what you bring to the table matters. I do agree also in a way that in India, flexibility is absolutely necessary because you don't know where the next opportunity is, how it needs to be structured, what stage the business necessarily needs to be in. The problem is who deserves that flexibility? Very few people in my mind yet has deserved it. And so what do? We have to bank on that we're going to believe in you doing something. And if you can do that something well, that base something, then we're happy because we know at least we'll make something. And then if you have some flexibility above and beyond that to help prove out what needs to happen on a go-forward basis, fine.
So Ajay, Samir spoke about the way he's building the institution. What has been your specific kind of evolution and learning over the last 4 or 5 years since you've set up CX Partners? Both on team and in the investment side.
Well, to begin with, I think I do agree with Tapan that if you have a 7-year or 5 to 7 year perspective, you will certainly have some changes, probably not major, and you want to be consistent with what you've done. But when you make those changes, I think one of the things that we've done or tried to do well is to communicate them much in advance and get our investors involved in the process of almost co-determining the strategy or convincing them that this may be the way to go. I think we are much more into a partnership mode where earlier I thought we saw ourselves primarily as investors with a 15 to 20% stake. Today, we see ourselves as partners with the companies with much larger stakes. Our primary source of exit in those days were capital markets. Today, we less rely upon that exit, and we are, in a sense, partnering companies for strategic sales. So that's a big change in terms of how do we see exits, how do we see our companies. And once you have the company wrapped up in a partnership model, the acceptance of the company to accept your operational improvements that you want to bring around through your in-house team, I think that becomes much larger. We still believe in partnering with entrepreneurs for delivering great returns. But I think it's become closer to the model.
Let's move on and talk specifically about first-time fund managers and how LPs view first-time teams, first-time managers, first-time funds, and delve into that. And I'll invite NIRAV to kind of give the remarks on that as to.
Again, I think our mindset as a firm is most likely a bit more opportunistic because, again, we're looking at true relative risk return. And as a bias, we have invested of the $4.3 billion we've invested. We have about 60% into what we call emerging managers. So funds 1, 2, and 3. We believe that most alpha is created in the early early days of the life when again, firms are hungry and really excited about working hard to create value. Instead of giving you a lot of qualitative words, I'm going to give you 3 specific examples and give you a little color about each of them that we have, of commitments that we've made in India. So of my 4 commitments in Indian funds, 3 are first-time funds. The only one that's not is Sameer's fund. So, and you'll see kind of why we got comfortable with that for, in each case, a little bit different reason. So the first one that we made was actually in the year 2005. And it was driven first and foremost by a top-down view that the residential real estate market in India was an interesting place to be, with obviously FDI regulations loosening up, with this huge consumer demand for housing. And the approach that we took there was to partner with someone that I had a relationship with personally. So first and foremost, trust, right? The trust was established there. And because we got comfortable with this individual, we felt comfortable with that person leading the organization. But the caveat was, this person had never invested $1 in their history. They knew real estate in India quite well, but they had not invested. So how did we think about then making that commitment? Beyond that was, we said, okay, how do we help this person build an organization around them that lets us get comfortable? And we had the benefit of a very large global investor based in the US that we think is one of the best investors in the world, take a 50% kind of fund commitment position in that group and sit on the IC. And with the expectation that they would be incredibly involved on a day-to-day basis. Top-down view that this was an interesting space, partner with someone that we really liked and we knew well personally, and then help them think about who else they could bring to the table that would really help us from a governance and pure investment mindset value add.
Tapan, would you like to add on your perspective? You spoke a little bit about
I did actually. I thought this was what I was supposed to speak first. So
Okay,
I mostly share what I had to. But a few things. I mean, based on the same thing that Nirav mentioned about trust, it's not that the sovereign funds have any bias against first-time managers. It's just that they don't have the trust. So what they do is, as Ajay was also mentioning, they go for the established brand names. They go for names that they can't be blamed for if something goes wrong. The other thing that could be helpful for the first-time managers, now that most managers are talking about operationally improving their companies, is in some cases we've noticed that although they talk about operationally improving companies, but at the GP level, you don't have as many ex-CEOs participating in the fund as managers of the fund. So I think there is still a tendency to not consider the operational people as peers at that level in the GPs. And if that was to change, and if the GPs were to demonstrate that they actually have people who worked in the industry for several years, and not just financial services, from where most of the people come from, but actually from manufacturing, retail, etc., whatever strategy that the fund is following, it would be a great help to build that trust and confidence amongst institutional investors.
Great. Let's move gears and ask maybe Ajay and Sameer about who are the investors who are backing made-in funds. I mean, since you guys have raised first-time funds, second-time funds, who are the type of LPs that you feel are more prospective LPs? Sameer, you want to start?
So let's break down the universe of all the investors out there, just very broad buckets. You have fund of funds. You have family offices / high net worth individuals. You have pension funds that tend to be what I'd call the private pension funds / foundations. You have endowments, which is a big market for private equity. And then you have sovereigns. And then the final, what I'd say, is you have the state pension plans, primarily in the US. So those are 5 or 6 buckets. You'll find that, at least in my experience, all of them move at different stages, at different speed, and have different appetite.
Ajay, do you have any remarks here?
No, I agree with what I don't really have anything to add. But what I'm interested in asking Tapan is, we didn't get a single cent of money from the Middle East. And how do you crack the Middle East? it remains an enigma, quite a mystery. And I've never understood how you navigate those corridors to get to a Middle Eastern investor. So if you can tell me.
Yeah, I think it's purely because of lack of investing in geographies like India, because of which Middle East investors are very nervous. One. Two, what is the perspective that they carry about emerging economies from a corporate governance point of view? Very poor. So, and when you're institutions, you don't want to take that kind of risk. I highlighted this earlier that...
But Tapan, if I can add to Ajay's question.
Yes.
My experience with the Middle East investors, especially the sovereigns, they are very brand conscious. And so, for example, if hypothetically a KKR was raising an India fund, I think it would be an easy decision for a lot of the large, relatively speaking, to let's say an Everstone or a CX. And that once the brand has been established, then it becomes a much easier conversation. Secondly, the deployment has to be reasonably large. And so fund size starts to matter as well beyond a certain point. I mean, we have a couple of Middle Eastern sovereign investors, one in our real estate fund and one in our private equity fund. And look, it's really, I mean, 50 million was a waste of their time, to be honest. And for us to digest, 200 million to make it worth their time is a difficult thing to do at the stage in our business.
You said the most important thing in the end. But we'll open up. We have about 10, 15 minutes. We'll open up for questions at this stage. I've been asked to open up. So there's somebody with the mic there. If anybody has questions from the floor.
Purnesh from Empower Capital. Most of the private equity funds in India sourcing capital from overseas. Is it possible to raise capital from domestic sources? There's a lot of happening in India, a lot of wealth has been created for a period of time. If so, what are the target areas we can target to raise capital, private equity capital in India?
Samir can take that.
I think I might be the only guy on the stage with an Indian fund, with Indian rupee capital, something I will never do again. I think we have one fund that we raised very early on, which was a rupee tranche for a dollar fund in our real estate business. And I can tell you that I find it to be a challenge. I don't think that the Indian investor is ready for private equity. I think that they have a very warped sense of what duration should be. And by the way, it's not warped for the wrong reasons. It's warped for the right reasons, because we have gone from mutual funds that have daily liquidity to suddenly 8-year, 10-year lockup capital, where the investor is not able to entirely adjust so quickly. I think there have to be some intermediate steps in between. So I think what ends up happening is that expectations are mismatched. I think people are not able to ride through cycles. I think the thinking generally is very short term, all again for the right reasons. So my sense is that people do raise money in India all the time. We've seen that. I think at the end, the industry is still very, very immature. You can raise the capital, although these days it's very difficult because most of it is really high net worth money. You're also competing, by the way, with the credit market. Forget about the equity market. Just think about it, right? I bought personally some bonds, which all of you know was a public issue. It's, we all probably bought some of it, 9% or, 8.75% tax free. The Indian, that's 14, 15% pre-tax. So that's your benchmark, and that's Government of India risk, right? These are state agencies. How do you compete with that from a return perspective? How much more risk would you take, and how much more return would you expect to compete with a pre-tax return of 13.5%? Very hard to compete with that. So that's the second reason. The last reason, what I would say is that we are in a probably, the last time I looked at the venture capital regulations, it really, I think it's not at all thought through in the detail that it should be. I think it's a mishmash of a lot of interested parties who've given their points of view. And if to be a regulated entity in India managing private equity or real estate funds, good luck to you. I think you're going to spend more time managing the regulation than you're going to spend managing the money. So personally, I have a negative bias. I think until the regulatory environment is better, until the investors have had time to adjust from going from daily liquidity to 10-year lockup, and until you have a more maturing of the industry, I think it's a very difficult thing in the long term at this stage to raise rupee capital?
I'll give you just one simple example. If you invest in the public markets, you'll pay no tax if you stay in that one investment for more than a year. Here, if you sell your company strategically, because we invest in the private market, the Indian investor would then have to pay upwards of 20% when we exit. Now that alone can create a significant difference in returns. So what Samir said, and this is just one aspect of Indian regulations. And then there is something called pass-through of the investment, which goes through a trust. Managing all that is a very difficult thing. So amazingly, the way the regulations are written, it is more conducive for foreigners to invest in India, in the private equity world, than it is for Indians to invest in India. It's not a level playing field. Normally, countries, give advantage to their home citizens. But the way they are written, it's in fact the other way around.
This is Sunil from Tata Capital. This is for NIRAV and TAPAN. Considering that, let's say the new fund has a brand and trust, whatever is required for the new fund manager, and looking at Samir's question where the ticket size sometimes plays a dampener for the bigger funds. How do you see the ticket size flexibility for such kind of new funds when you have the other ingredients like the brand, the trust, or the the maturity or the track record?
I mean, quite frankly, some of the sovereign entities are understaffed. Yeah, so that's why the ticket size plays a very important role. There's only so many funds that you can track and invest in. So therefore, in the past, and it continues to be, that it has to be north of 50 million, and in some cases, as Samir was mentioning, 100 million, 200 million, otherwise they don't even look at it. But that's just Middle East perspective. But there are some sovereign entities in Middle East who are very well staffed. And if they are not able to find funds, if now they have a geographic allocation for India, and if they're not able to find funds who can accommodate the 200 million ticket size, I'm quite confident over a period they will start considering lower ticket sizes as well.
Great. We have time for...
Very quick answer. I mean, unless I'm missing something, if you feel like you're at the point where you've been able to convince these large investors to invest, I don't think that you should have a problem raising your fund. I don't think the limiting constraint is going to be ticket size.
Thank you very much for coming on stage and sharing your insights.